Welcome to my channel. Please like, subscribe, watch, and share.
Learning objectives. After completing this module, learners will be able to understand the monopoly market and its criteria in the commodity market, learn about the competitive market structure and its behavior, learn about the basic differences between monopoly and perfectly competitive market, understand the relation between the market demand curve and average revenue curve, learn the relation between the marginal revenue and average revenue curve, understand the relation between the average revenue and total revenue curve, understand the relation between the marginal revenue and total revenue curve, understand about the slopes of total revenue curve, about its shape and tangent trends on those slopes in order to understand the positive, horizontal, and negative inclinations of the slopes. Understand about the short-term equilibrium of the monopoly firm. Learn about the short-term equilibrium of the monopoly firm in zero cost. Understand how geometrically the total costs and total revenue values with curve can depict the profit curve. Learn about monopolistic competition and its differences from perfect competition and monopoly structure. Learn about oligopoly market structure and interrelated activities of duopoly firms. Simple monopoly in the competitive markets. Market structure of monopoly. Perfect competition market structure is determined through various conditions of consumers, firms, their individuality, and combined effects. Freedom of choices, non-substituting properties of the goods and knowledge, competitive behavior versus competitive market structure. In the perfect competitive market, the individual firm cannot control the market price. But in the case of the competitive behavior of the firms and the competitive market structure, they are appeared to be inversely related with each other. The monopoly in a single commodity market can be satisfied when the market of that distinct commodity is perfectly competitive. That is, all the consumers are price takers. Market demand curve, total revenue curve, and average revenue curve in monopoly market. In case of market demand curve, for the price rise, the consumers want to buy lesser quantity of the commodity. But in the monopoly market, firms know that the larger quantity of the commodity can only sold in lower price. For smaller quantity, the firm can sell its good in larger price. Thus, in monopoly market, the firms can control the price by the quantity of commodity as produced. The total revenue is the product of the entire quantity and its respective total price of the commodity. It has been seen that after 10 units of the commodities, the total revenues starts to decrease. We know that the price of the commodity altogether shows the market demand curve in monopoly market. The average revenue in monopolistic condition is measured mathematically when total revenue is being divided by the quantity of the commodity. If we will show it geometrically, then we need a connector drawn between the origin and the place of intersection of quantity and price in total revenue curve. Total, average and marginal revenue curves and price elasticity, marginal curve and its relation with total and average curves. The change in total revenue in response with the sale of the extra unit is called marginal revenue. That is, the newer total revenue values are subtracted with the values of previous sales. As we know that total revenue increases slowly as quantity increases, because for larger quantities in monopolistic conditions, the price rates eventually decreases. Graphically, we will measure the slope of any smooth curve by drawing tangents at different points. Here, the sloping pattern of the total revenue curve determines the marginal curve and the steepness of its slope. The marginal revenue values are always lesser than the average revenue values in monopolistic situations. Thus, the marginal curve lies always below the average curve. Marginal revenue and price elasticity of demand. The price elasticity of demand is more than 1 when the marginal revenue value is positive, and it gets lesser than the unit value when the marginal revenue values are negative. We can say that demand curve is elastic when the quantity is less than 10 units and the marginal revenue values are also positive. Short-run equilibrium of the monopoly firm. In the monopoly firm, every quantity produced is meant for sale, where at the level of distinct output, where the total revenue is maximum, the profit of the firm becomes also highest there. In this way, in monopoly firms, the total revenue area can be shown by the rectangle having the area of product of demand or average revenue value and the quantity produced. But in the case of perfectly competitive markets, where many firms are being operative, there the equilibrium happens at gradually decreasing prices in which the larger quantities are sold. Total, marginal and average revenue and cost curves and their interrelations. Total revenue and total cost curves, profit, revenue and cost. We know that the profit is that what we receive after subtracting total cost from total revenue. Sometime we can see that total cost curve lies about the total revenue curve. In that point, we can say that the firm is facing losses because profit is negative there. Marginal and average curves, revenue and cost. Till the point where the marginal revenue is greater than the marginal cost, the firm will be interested to add extra output, as in this point, the selling extra unit of output is greater than the total cost increment in order to produce that additional unit. In regard of average cost curve, we can get the total cost area in the product of average cost in the equilibrium quantity point and the respect quantity. For the demand curve too, we can get the total revenue in the product of average revenue and respective quantity in the same equilibrium point. Instances of perfectly competitive market, marginal and average curves. In perfectly competitive firm, the production to sale is larger than the same in the monopoly market, and the price is also lower than the latter. Thus, in the perfectly competitive market, the profit is lesser than the monopolist situation. It is fact that the monopoly firms enjoy the profit in long run as well, which is not possible for competitive firms. Additionally, having with many diversified substitutes of every product, a monopoly firm cannot restrain from the competition for long time. Other non-perfectly competitive markets. Monopolistic competition market structure in short term. In a specific market structure, many firms will operate, and they have the rights of free entry and exits. But the goods produced do not have any similarity with each other. Such of this market structure is called monopolistic competition. We can think a market of wheat flour where various brands with respective packages, where every customer already builds their personal choices and tastes with respective brands. There may be many producing firms in the market, but the specific brands are few. Monopolistic competition market structure in long term. As it is narrated above, the price of product being lesser than the perfect competition stays higher in monopolistic competition than its perfect competition counterpart. But in the long run, other firms can enter in the monopolistic competition when they see the existing firms get positive profit in the short run. This results prices to reduce periodically till the profit becomes zero. How do firms behave in oligopoly market structure? In oligopoly market, more than one firm works but not many. In duopoly firm structure, where the products are homogeneous and have no substitute for each other, two firms can react like a combined firm having no competition with each other. Secondly, they decide about their productivity in order to maximize their profit after seeing the productivity of other firm and assuming that should not be changed. In oligopoly market, if one firm increases the price of its product, its number of sales is dropped and this is not followed by the other firm. But when the firm lowers its price in order to sell more products, other firms become compelled to reduce their prices too. Thus, it has been seen that the firm first sees comparatively less increase in the quantity sold in respect with the price reduction rate in the long run. Summary. Let us summarize what we have learned. The market structure called monopoly exists where there is exactly one seller in any market. A commodity market has a monopoly structure. If there is one seller of the commodity has no substitute, and entry into the industry by another firm is prevented. The market price of the commodity depends on the amount supplied by the monopoly firm. The market demand curve is the average revenue curve for the monopoly firm. The shape of the total revenue curve depends on the shape of the average revenue curve. In the case of a negatively sloping straight line demand curve, the total revenue curve is an inverted vertical parabola. Average revenue for any quantity level can be measured by the slope of the line from the origin to the relevant point on the total revenue curve. Marginal revenue for any quantity level can be measured by the slope of the tangent at the relevant point on the total revenue curve. If the monopoly firm has zero costs or only has fixed cost, the quantity supplied in equilibrium is given by the point where marginal revenue is zero. In contrast, perfect competition would supply an equilibrium quantity given by the point where average revenue is zero. Equilibrium of a monopoly firm is defined as the point where MR is equal to MC and MC is rising. This point provides the equilibrium quantity produced. The equilibrium price is provided by the demand curve given the equilibrium quantity. Positive short-run profit to a monopoly firm continue in the long run. Monopolistic competition in a commodity market arises due to the commodity being non-homogeneous. In monopolistic competition, the short-run equilibrium results in quantity produced being lesser and prices being higher compared to perfect competition. This situation persists in the long run, but long-run profits are zero. Oligopoly in a commodity market.
Thanks for watching my YouTube channel VD Education. Don't forget to like, comment and share.